Hello, I'm Sam Stovall, Chief Equity Strategist of S&P Capital IQ. At this week's Investment Policy Committee meeting, we discussed the attractiveness of stocks over bonds based on the S&P 500 earnings yield. As of May 13th, the earnings yield on the S&P 500 was 5.4% based on trailing 12-month GAAP earnings, which was nearly 3 times as high as the yield on the 10-year Treasury bond. The last time the earnings yield was this far above the 10-year yield was in 1955. Indeed, since December 1945, the earnings yield, which is the inverse of the P/E ratio, averaged 1.6 times that of the 10-year bond. Common wisdom holds that if stocks are yielding a lot in earnings relative to bonds in interest, stocks are more attractive than bonds. Therefore, history says, but does not guarantee, that the current 2.8 times multiple of earnings yield to bond yields makes stocks look attractive. In prior periods when the earnings yield multiple was above 2 times, the S&P 500 climbed nearly 12% in the next 12 months and rose in price 71% of the time. Taking this comparison one step further by looking at today's earnings to bond yield multiple, we see that all 10 sectors in the S&P 500 are trading above their long-term averages. Therefore, since stocks are yielding nearly 3 times in earnings what bonds are yielding in interest, history suggests that stocks may be the more attractively valued asset class. And since the cyclical sectors are trading at a higher premium to their normal earnings to bond yield multiple than the defensive sectors, the recent rotation into the cyclical sectors at the expense of the defensive ones is a trade that appears to us to have some sustainability. I'm Sam Stovall, and I'll talk with you again next week.